You're sitting at dinner, and someone casually drops a conversation stopper. Honestly, renting is just throwing money away. Suddenly, everyone is nodding. Buying a home has become the undeniable benchmark of adulthood. You watch your friends post photos of their new front porches on Instagram, and your coworker closes on a new place. You go home, check your savings, and the panic sets in. You wonder if you're falling behind, if your financial future is standing outside in the rain while everyone else is moving on. And it always comes back to that one escapable phrase: renting is throwing money away. It's a piece of conventional wisdom so ingrained in our culture that it feels like a law of physics. Letting that feeling drive your choices means you are making the largest, most consequential financial commitment of your life based on social pressure and dinner party vibes, instead of actual math. We usually start the math like this. You look at an $1,800 monthly rent payment, compare it to a $2,100 monthly mortgage, and think that for just $300 more, you could own. Comparing rent to a mortgage payment is like comparing the price of a gym membership to the cost of building a full commercial gym in your basement. It is an incomplete calculation. That base mortgage payment is just the entry fee. To actually keep the house, you have to pay property taxes, homeowners insurance, maintenance, HOA fees, and higher utility bills. None of those extra expenses build equity. They are unrecoverable costs. When you rent, your unrecoverable cost is the rent itself. You're buying a service, shelter, flexibility, and a landlord who has to fix the plumbing. The decision comes down to which specific set of unrecoverable costs you are willing to tolerate. Look at a standard 30-year amortization schedule. People assume every payment immediately stacks into a wealth vault. But early on, the bank takes its cut first. Most of your payment goes toward interest. Your principal moves very slowly. Then you add the property taxes, the insurance premiums, and the golden rule of home maintenance. Expect to spend at least 1% of the home's value every single year just keeping it functional. Water heaters often fail right before the holidays. In those early years, you aren't rapidly building a real estate empire. You've signed up for a highly expensive subscription box for household stress. This math gets dangerous when people buy a house simply because they are tired of renting, but end up moving or selling after just 3 or 4 years. Buying and selling real estate is full of friction. Even if your property's value goes up by $50,000, you have to subtract the agent commissions, the closing costs, the repair concessions, and the moving fees. Those transaction costs can easily erase tens of thousands of dollars. By the time you hand over the title to the next buyer, you might actually walk away with less money than you originally started with, despite the house appreciating on paper. If your time horizon is short, a house traps your liquidity and actively destroys your return on investment. Then there is the entry price. To get the house, you have to lock tens of thousands of dollars into a down payment. All that money goes into the walls. Financial professionals call what happens next opportunity cost. Once that cash is parked in the property, it is no longer liquid. It has one job and it cannot do anything else. You can't use that $40,000 to launch a business. You can't invest it in a low-cost index fund. You can't use it as a runway to quit a toxic job or make a sudden career pivot across the country. A home can grow your net worth over time, but tying up your available capital concentrates your wealth into a single asset in a single neighborhood, reducing your geographical and entrepreneurial flexibility. Now let's look at the alternative. In our scenario, renting a similar property costs roughly $1,300 less per month than owning it, once you factor in all those hidden costs. If a renter takes that exact cash flow difference and consistently invests it into the stock market over decades, compound interest takes over. The mathematical advantage of renting can be substantial. This quadrant chart maps wealth behaviors. Without a bank demanding payment, most renters let lifestyle creep take over. But a mortgage enforces discipline. Homeowners have higher net worths because they are contractually obligated to pay down principal every single month. Claiming "I will invest the difference" sounds smart on a spreadsheet, but in reality, it is a dangerous lie unless you possess automated psychological discipline. If you don't actually have that discipline, in the end, renting will not make you wealthy. Filter your specific life through a practical framework. Start with your time horizon. If you won't stay 5 to 7 years, keep renting. Friction costs erase gains. Second, run the budget including taxes, maintenance, and an emergency fund.
Otherwise, you're renting with extra anxiety. If you value flexibility, have a shorter timeline, and possess the discipline to auto-invest your savings every month, renting is a strategic move. If you crave geographical stability, plan to stay put for a decade, and need a structured system to force you to build equity, buying a home works well. Neither option is a failure. They are simply different financial tools that require entirely different life timelines and psychological profiles to work. You are not behind just because you currently rent, and you are not automatically ahead of everyone else just because you sign a 30-year mortgage. It's time to silence the noise. Ignore the coworkers, the parents, and the Instagram posts. Your friends' housing choices are not your financial plan. Financial success relies on making housing decisions from a position of objective, calculated strength, ensuring your money matches the actual life you want to build.